we have 3,500 real estate investor clients. It told me, right? Yeah. Of exactly how many 1031 agents could actually do this and are licensed to do this.
The big thing for me was my father was a tax attorney. I really wanted to get into helping individuals really unlock the opportunity to defer huge amounts of taxes. We talk about the power of compounding, right? The deferring taxes. And that power is monstrous. High net worth, very wealthy families, and they have been doing this for the better part of a century. You almost never pay a dime in tax on so much of this while deferring your income along the way. And our goal is to spread the word of this is the biggest opportunity that many people aren't taking advantage of. And our business is one that folks need to use in order to execute.
You're about to hear from someone who's managed billions in commercial real estate and is now disrupting a niche that most investors sleep on until it's too late. Jeff Bemis is a CPA, a CFA, and spent 15 years deploying capital at a $4 billion hedge fund. Today, he's the co-founder of 1031 Specialists, a company quietly helping investors legally defer millions in taxes and unlock permanent wealth transfer strategies. If you're not using 1031s the right way, you're leaving real money on the table.
What I've realized in my life is recognizing the idea is part of it, but 95% of it's in the execution, right? You know, the execution, the capital, the
100%.
performance. If you have somebody who's an eager buyer, you can utilize opportunities to extend the close, which give you more time, reinvest the $500,000 in equity, and then you would need to buy $1 million property. Again, if you do that, you do not pay a dime in tax at the federal or state level.
Right.
Don't let tax wag the dog. I mean, don't do a bad deal for bad deal's sake just to defer tax.
Jeff Bemis, welcome to Real Estate Profit Boost, buddy. Glad to have you on here. And of course, I don't like to go into a huge bio about you, but just a quick background on Jeff. He started off as a CPA, yes, at one of the big firms. Eventually, he found himself in California running, close to a $4 billion, let's call it private equity fund in real estate assets. So this guy knows a lot. And now he's in the middle of a roll-up in something that is very unique, right? So when I met Jeff and his co-founder, I was extremely impressed in the strategy and what they're doing with 1031 exchange. And he is the co-founder of 1031 Specialists, and he knows, you name it, he knows it, from the capital stack to private equity to you name it. So with that being said, Jeff, tell us about your newest project and why every real estate investor should know exactly what 1031specialist.com, S plural, is all about.
Well, yeah, appreciate that, Jerry, and it's a pleasure to be here on this awesome podcast. I've had a very colorful career in real estate. I've done a lot of different things, and like you mentioned, deployed billions in capital into all kinds of varying real estate strategies and things that have been wildly successful. The big thing for me was my father was a tax attorney. I really wanted to get into helping individuals really unlock the opportunity to defer huge amounts of taxes. It's 1031 exchanges are, while many know about it, there are way more who should be taking advantage of it. And our goal is to spread the word of this is the biggest opportunity that many people aren't taking advantage of. And our business is one that folks need to use in order to execute on a 1031 exchange. And so we're all about providing value, consult, and execution around doing that.
So I agree with you, right? So, I've been investing in real estate for, almost 3 decades. And obviously I own an insurance agency that insures over $4 billion of real estate alone in Florida. Why do you think the average real estate investor, if they're not sophisticated, why don't they know what a 1031 is?
It's very layered, and it's very interesting because we work with thousands of commercial real estate brokers and residential brokers across the country. Mm-hmm. And when you talk to them, I think it's education all up and down the real estate continuum is very low. And it feels intimidating. It feels like a process that isn't worth it. It feels like, it creates a bunch of constraints around what you're trying to execute on. And ultimately, I think it creates some intimidation around it, but it's also a lack of education on the topic. And folks don't think they need to care about it, but they really do. I mean, in my neck of the woods in California, there's a reason that all the very, very large family offices, and there's a very large amount of high net worth, very wealthy families, and they have been doing this for the better part of a century. And the beauty of it is as you pass assets down to heirs and your basis steps up, you almost never pay a dime in tax on so much of this while deferring your income along the way. So I think that's why it's an education dynamic. Awesome. Yeah.
Right. I mean, to give you an idea, how did I hear about what a 1031 exchange was, right? I moved down from New York. I started acquiring properties in Miami. And of course, as a beginner investor, because that's our audience as well, for me, I had $10,000 worth of capital in my pocket and a credit card. I bought my first fourplex for $150,000, literally with 10% down, and used a credit card for closing costs. But see, for me, right, because people are always looking at NOI or ROI or cash on cash. But see, for me, I lost my butt on Wall Street from the tech bubble, right? Wiped out. So I started with a mentor in real estate. So it was critical. I bought a fourplex for $150,000. I put down, let's just say 10%, 15 grand. And then 12 months later, I sold it for $180,000. So in essence, I turned to my 15 after closing costs, let's just say to 30 on a double. So I looked at it as, okay, I got a 100% return in 12 months. And I found out real quick when I didn't know, and my accountant called me and said, okay, you got to pay taxes on it. I go, but what do you mean? What did you do? I go, I immediately bought another property. So my accountant says, here, I got a phone number of this girl named Susan. She's a 1031 fiduciary. And that's when I first found out it was too late. And by the way, my track record was from 2000 to 2007. I started with that 15 grand and ended up with almost 24 million in equity strictly from 1031, 1031, 1031, 1031. So going back to, I had no education. And you know what? My CPA didn't inform me, knew what I was doing. And then he said, call Susan. So I think you're solving this problem with 1031 specialists, right? .com.
Yeah, absolutely. I mean, and the goal is to get tools out to people so that they can feel informed. We've built a lot of different things, including, the first of its kind 1031 AI that is very dedicated, and it's on our website, that answers questions. And the goal is that people can be informed of what's going on. And our whole idea around this is we can be really proactive to help the community learn about the benefits. And if we do this when we do a lot of different talks, of which I do a bunch of them, we talk about the power of compounding, right? Deferring taxes. And that power is monstrous. Just like your example of over a 7-year period, compounding that into, a monstrous
eighth wonder of the world,
right? Right. You're not the only one, right? And if you think about where the taxes that you would pay, there's depreciation recapture, there's capital gains tax, and then there's state level tax, depending on where you're at. Those can be 30 to 40%. And so every time you sell, you do that. You don't pay that, and then you just keep rolling into the next. The yield profile and the amount you can reinvest just compounds massively, and it's really why real estate is so powerful versus stock, bonds, other sort of financial products. Is this nuance and it's not really a nuance, but this characteristic of real estate and how the tax code works.
Right. Okay. So, give us the basics of 1031, right? Just in case nobody kind of gets it, and the basic rules and things of that nature. What is it at its essence?
Yeah, so a 1031 exchange is when you own an investment property, and it can be used for business purpose too. But by and large, you own an investment property. Let's say it's a duplex. You've owned it, and it has a lot of gain involved. So most people, so you buy for $500,000. Let's say it goes up to $1 million. And you have a lot of embedded gain. And also depreciation you would take on it would also increase that gain from a tax perspective, just worth mentioning. So if you have, let's say in an example, it doubled in price and you had a $500,000 gain, if you sell an investment property and you want to buy another investment property, of which we can talk about all kinds of reasons that folks want to do that, you can reinvest all the money that you receive, as long as you reinvest all the equity you get. So after you pay off the loan, all the equity you get, and you buy a property of equal or greater value also as an investment property, this is a big thing that needs to be noted.
Investment property and equal of greater value.
Equal of greater value. So if you whatever equity that you get out of the property, you need to reinvest all of that, and then the property price, right? So if it was $1 million property and you paid off a $500,000 loan, you'll have $500,000 in equity. You need to defer all the tax. You reinvest the $500,000 in equity, and then you would need to buy $1 million property. Again, if you do that, you do not pay a dime in tax at the federal or state level,
right?
And so you can reinvest the entirety of the proceeds, and that's the quick version.
Okay, so let's say I owned a property for $750,000,
yep.
right? I owed the bank $500,000. I've owned it for a minimum of 12 months. I sold that property for $1 million, which is a $250,000 capital gain.
Right.
If I sell it within 1 year, I'm subject to ordinary income, I believe, right?
Yeah, short-term capital gains. Yeah, that would be taxed at ordinary level.
Short-term capital gains and ordinary income, and then after 12 months, then it's long-term capital gains, which is less, but still a 22 point whatever, depending on the state, right? If you live in California or New York, you're paying more. So at that point, I sold it for $1 million. I have a $250,000 capital gain, and how much equity? That leaves me with $500,000 equity, right? Based on my math,
$500,000 in equity. Yeah, I'm following you. I'm with you.
Can I buy a property that's $600,000, or do I have to go over $1 million? Or, let's get into the little nuances or can I buy multiple properties, or does that $500,000 in equity, right? It's the equity. Is that the important piece?
Yeah, it's you must reinvest all the equity you get, and you must buy a property of equal of an equal value to the net selling price. So after you pay commissions and other fees, if you have any lawyer's costs, title, etc., the net selling price must be reinvested. So that $1 million sale, you must buy a property of $1 million, and you must reinvest all the equity that you got out of the property in order to do that. Right. So you can bring new capital to the table. That's absolutely the case. You can sell multiple properties, buy one property. You can sell one property, buy multiple properties. We have clients doing that all the time, and it must be in the United States and a few territories. But it must be in the United States, but it can be any property type. Like, one thing we always tell folks, and we get this question a lot, is and particularly in this day and age with baby boomers and people inheriting a lot of property, land, which is not a yielding asset, you can swap for multifamily, you could swap for hotel, you could swap for office. Not that many people want to do that right now, but you could swap for any kind of piece of commercial real estate, or it can be a single family residential property, as long as it's for investment, right? It needs to be for investment or business purpose. That is the key requirement.
Okay, so that's interesting. So it can go from land to multifamily, it can go from office back to land, as long as it doesn't have to be income yielding, but as long as it's an investment property and more or less, let's call it, not your primary residence, right? Not
your primary residence, and also not a vacation home that you have that you use roughly over 2 weeks a year, to keep it simple.
Okay.
So investment properties and vacation properties, if for the prior 2 year period you only use it a de minimis amount, then that's an investment property. But if you're somewhere where you're there 6 months, that would also preclude that. So primary
2 weeks, according to the tax code. You want higher profits without higher risk. The blueprint's right here. Hit subscribe and watch Real Estate Profit Boost. Okay, so tell us, go ahead, about the times and all the time frames, because again, it's the details that matter.
Right.
And it may sound like, oh, we're going over too many details, but if you miss a detail, like I didn't know that, like second home, as long as you only use it 2 weeks a year, it's considered an investment property, and I can 1031.
Yeah, correct.
Like if I wanted to buy a condo in Vail, and I'm only using it for 2 weeks a year, and the rest of the time it's an investment property. Okay, did not know that. Thank you very much.
Yeah. And these are things that come up all the time that we help folks out with. I mean, there are requirements, and this is all dictated from and by the IRS and supplemental guidance out from the IRS.
Got it.
So this is, the primary constraints that exist in the 1031 exchange are you have a certain period to identify replacement properties. and you have a certain period to execute and finalize the purchase of your replacement property if you're doing a standard forward exchange. So as an example, when you sell your property, and again, we always tell folks, planning ahead really mitigates a lot of this, and folks are really concerned about timelines. And what I would say, if you're planning ahead, the timelines we don't find for clients who do some preparation, they don't find that to be particularly problematic, because a lot of this can be done while you're in escrow or right in front of being in escrow, and so you have extended timelines than these formal dates. So when you sell your property and you close escrow and you transfer the property as the operative word, that is when your timeline starts. So when someone purchases your property, you have 45 days to identify your replacement property that you're going to buy. And you can swap it as much as you want in the first 45 days. And you can identify, there's two different primary ways that people do it, where you can do 3 properties of any size and any price, or you can do as many properties as you want, up to 2 times the amount of the fair market value of the property you're selling. So if you had $1 million sale, you could identify 10 properties of up to $2 million. There's one other way, but it's very rarely utilized. So most people do the 3 properties. Got it.
Yeah. Understood. And you mentioned the term forward 1031. Now, I'm not going to ask you yet, but we're going to get to a reverse 1031. Right. Just for people so they know that's coming soon, right? Because most people don't know what a reverse 1031 is, or a partial 1031, and so on. But a question. So we deal with around 3,500 investors, and I'm an investor, right? Yeah. In this market, I get, it's very difficult, right, to find a deal. Here in Florida, we're almost at a standstill, right? Because 24 months ago, things were selling at a 5 cap, interest rates were low, so let's call it on multifamily, stuff was selling at $250 a door. Today, when you underwrite, a 5.5 cap in Class B multifamily, to get that, you got to drop to $210 a door, right? Between insurance, interest rates, and all that kind of thing. So a lot of people are afraid of that 45-day, I have 45 days to identify a property, and then I have the 6 months to close. Tell me, what does a sophisticated investor, because I know you deal with family offices, not just a guy who owns a fourplex, right? What do they do about this? Is there any tricks of the trade? Can you give us some kind of insider here?
Yeah, the main tricks of the trade are... and again, every deal has nuances on whether you can negotiate these elements, but the tricks of the trade generally are ways in which you can extend escrow if those opportunities are available to you, because it's so hard to find deals. And if you have somebody who's an eager buyer, you can utilize opportunities to extend the close, which give you more time. There's also different frameworks you can do in and around how you close, because ultimately it's when you close is when that timeline starts. That those are things that I think people are really mindful of, and so that is the harder part. Again, reversing for people who are very well capitalized, which is generally the profile for reverse exchanges, and again we'll get into that in a minute. These are markets where reverse exchanges become more interesting, and that's where you buy your property, your replacement property first, and then sell the property you own second, and so you have a little bit more control over timelines in that dynamic. But as far as the tricks of the trade, it's working and being creative around how the timeline you close. And I would tell you, it's more about being ahead of the game and understanding where you want to be. And just, it's worth mentioning that there is no
I like
penalty.
What you said. Yeah, go ahead.
I was just going to finish the thought of, it's worth mentioning that there's no penalty to embarking on a 1031 exchange. And if you don't find replacement properties, a mentor of mine in my career, given I've been in sort of the CPA land, is don't let tax wag the dog. I mean, don't do a bad deal for bad deal's sake just to defer tax. There is no penalty for embarking on this identification. It would just be like any other real estate transaction. While no one wants to pay the tax, there is no penalty or downside on top for embarking on it if you don't find those replacement properties.
Right. That's in a reverse 1031 exchange. But if you're in contract to sell a property and then you embark on a 1031 and you don't find it, then you're subject to the full capital gains.
You'll be subject to the tax. I'm just saying there's no additional penalty for doing that. There's no additional dynamics around it. It's
Got it.
Be like otherwise.
You said some key words there. What was that lesson you learned? Don't let the dog wag the tail, or the tail wag the dog.
I believe this. don't
Right.
don't let tax results drive business decisions solely, right? So that is something that I think is really important, just something to keep in mind. You may regret a decision where you buy something and you're like, I need to get into something, if it ends up not being like it. Like, don't take undue risk just to defer the tax.
No, I get it.
Yeah.
So I had a crazy offer from a hotel short-term operator on one of my 14-unit apartment buildings, right? Okay. And I'm like, at normal rent increases to get this price, no way. So I'm going to sell it. And yes, there's a huge capital gain. He's paying me $1 million over market on this thing. But I'm asking myself, really? I'm even willing to pay a prepay on my loan, right, of a point on this kind of thing. So I get that, and thank you for that advice. So, yeah. But at first, my first reaction is, and sometimes this is where CPAs can, not do us justice. He's like, well, wait a minute, don't sell that building. You've been depreciating it for 12 years, and this. I'm like, yeah, but cost, what do they say? It's the opportunity cost of the money, right? So
yes.
I'll get huge with a 1031 because I'm 3 1031s into this property, right? But when I look at the value he's willing me to pay, if I wait for my rent to go up with inflation, right? That's 15 years away to that number. So I'm like, I'm selling it. I'll pay the taxes if I don't find a 1031.
Yeah.
So, right. So back to what you just said. So the way what I heard, which I have not heard before, is the way to play it is if you're going to 1031 and you're an investor and you're afraid of the 45-day and the 6 months to find a new property, the way to do it is on the sell side, right? That's what you're saying. Extend your escrow. So if I heard you correctly, you're saying things like, okay, let's say I get a $5 million offer on that property and 30-day due diligence, 60-day close. If I put into the contract, okay, I'm identifying a 1031 and I have the right to do 3 30-day extensions, right? In that contract on the sell side, right? And as long as the buyer is okay with that, but then I can keep triggering that, and you technically, you're in contract, you go hard on a 10% deposit after due diligence, right? And then you can keep executing that extension, technically buying yourself an extra 90 days, as long as the buyer really wants in there, and the guy's not going to walk from a hard deposit. That's what I heard.
Yeah,
you say,
I think that's
right?
exactly right. So if you can, again, it gets into the dynamics of, I think the marketplace now has more is more ripe for that kind of thing than because when people find deals they want, they really want to close on them. As you mentioned, it's hard to find the deals that you get real excited about. So those are exactly the kind of things that you can consider and build in, and it can give you a lot of optionality, certainly. So it's not always easy to do, and people don't think to do it. I would say more commonly, it's just being prepared and knowing where you're at and getting a sense of how much demand is for your property. And as it starts getting a little bit closer, just really getting out there and more intentional about how you source your replacement property. It really, most of the time, that gets the job done.
Got it. So a question, what's the most money you've ever seen saved from a 1031 exchange?
Yeah, I mean, there's REITs and others doing $150 million transactions where the basis is super low. So I would say tens of millions are getting saved. Millions. But if you think about even an investor like you who's rolling, we have clients all the time who have almost no basis in their property, right? So they've been earning income on their investment properties. They've been offsetting their rental income with depreciation expense. And so that lowers your tax basis, and the tax basis is how you calculate your gain. But so you're getting the benefit in real time of paying less tax on the money you earn, which is great. And then you have reasons to swap your property, which you identified. And look, I just had a client who doubled their yield profile by changing geographies. They had someone who wanted to invest who really wanted to do a big fix up and had a big sort of grand plan that he thought contained a lot of risk. I happen to agree with him. And so he swapped into another geography. He went out into Arizona, doubled his yield profile versus where the purchase price was. And so with that, he did it. And the basis that folks have in these properties is very, very low. I mean, we just had a gentleman who has a $4 million fair market value property where his basis was a couple $100,000, if not lower. And and so he's going to pay, he's a California person, he's going to pay a million in tax at least if he did it. So he decided 1031 exchange, roll the whole thing. He gets $1 million of additional investable capital, plus you can borrow against that, right? So he's going to get $2 million of additional property to make earnings on. And it's just, it makes all the sense in the world.
No, it makes a lot of sense. So you deal with a lot of, sophisticated investors. You've managed, a $4 billion real estate fund, all that kind of things.
Yeah.
Do you find that most sophisticated investors, institutional or sophisticated, they never really pay capital gains tax, right? So like from the beginning, right? Like all of my properties are depreciated, right? And every time I sell, I never really take my chips off the table.
Right.
You know what I mean? Because of the 1031 rule. And I have, like you said, my tax, I'm depreciating a property for 18 years. I paid $1 million. It's $200,000 left. Then I 1031.
Yeah.
When does the buck stop? Or does it, the sophisticated investors, it never stops, right? It's always deferred.
It's always deferred by and large. The only reason if they have some particular reason or they have, because these folks have attained an enormous amount of wealth through doing this strategy. And I would say, other than some reason they need to monetize some of the capital for whatever it might be, and oftentimes it's dealing with inheritance and patriarchal family dying and how they need to sort of handle all their estate taxes and estate planning. Right. Otherwise, for most people, if you right now, if you're husband and wife, you'll have $26 million in gift and estate tax exemption.
Because of the
right?
Trump, the old Trump rules, right?
Yeah. So it's been going up. I mean, obviously that changes through time. So obviously you'll have to refresh every year on this because it's such a change. But point is that people defer taxes all the way through their lives. They create family and generational wealth and multi-generational wealth because when their heirs inherit the property, they step up in basis, and because the estate and gift tax is so large, that exemption, that is, you don't pay any inheritance tax, and then you end up with a property that has a basis at the fair market value, and if you sold it then you wouldn't pay any tax. So there ends up being a never pay the piper. And I would say the other thing about real estate that makes it uniquely awesome for this strategy.
That's very valuable, right? So for those who, I know there's a lot of sophisticated clients we have and an audience, they understand the term basis, right? So that's the first purchase price, their basis minus depreciation and things. And then he mentioned a way to transfer wealth and step up the new basis, right? That's exactly what I heard. Right. Give me that in one sentence so they understand.
So when you pass away and your heirs inherit your property, they will move their tax basis, so the thing that the gain's taxed on, up to the fair market value of the property. So and then there is if you had almost no basis in a $2 million property and you sold it, you would pay tax on $2 million. If you hold it all the way to when the family member passes away and their heirs inherit it, you would step up your basis to $2 million. And if you sold it for $2 million the next day, instead of paying taxes on all $2 million, you'd pay taxes on zero.
Got it. Perfect.
It's a huge dynamic of where a lot of money is made versus really most other financial assets.
Real investors are using this boost to boost returns. Real Estate Profit Boost. So why aren't you? Watch now. Click below. No, I understand. This reminds me of the story of Joe Robbie. I don't know if you remember who Joe Robbie was. He used to own the Miami Dolphins, the Dolphin Stadium. Yes. Right. And it was a complete disaster because of his cost basis and the bad tax planning and the estate planning. And he liquidated the stadium, his real estate and everything, just to pay the estate taxes. Wow. And so there's some critical lessons in exactly, what you're saying and why, and it's important. And you can be a rookie investor, and, and that's the beauty of this show, is I'm trying to share it across, the board.
Yeah.
So with that being said, let's, later I'm going to ask you some, because you get a lot of real estate experience, right? But tell us what a reverse 1031 is, because
Right.
I'd say even the most sophisticated real estate investors, they don't even understand what a reverse 1031 exchange is.
Yeah, no, I mean, by and large, most exchanges are called a forward exchange, and that's where you sell your property, use that money to purchase the replacement property. Just by way, just to make mention, make sure you talk to a qualified intermediary like 1031 specialist before you do this. If you talk to us after you do a close, you will not be eligible. I just want to make sure I mention that. So if you're going to do a 1031
Critical.
exchange, you have to have us in place before you close. It can be really close
Right.
to the close, but you have to have us. I just want to mention. But so when folks on
And
the
by the
forward,
way,
Wait,
you
go ahead.
provide, like, so even even if I'm going to sell, right, I have to put into the contract that I'm doing a 1031 exchange, right? So on 1031specialist.com, are you providing, some contract language, the beginning steps, the knowledge, everything's there?
Yeah, we are very hands on, and we'll help you through every step of the way. If someone needs
Right.
some guidance on how to, we take an assignment, which is the formal dynamic of it in the contract. All this gets done very close to the end. You don't need to in advance, just so you know, when you're talking about properties with other brokers or other sellers, you do not need to tell them you're a 1031 buyer. Just as an FYI, we actually tell people you shouldn't do that. There's no reason to tell people that you have any constraints around what you're doing.
Did you hear
only
that?
need to tell them
Yep.
about before you close. So
He suggests do not tell people if you're a 1031 buyer. Why? Because they know you've got to close. They know you've got to move your money. So you lose your leverage in the art of negotiation.
Exactly.
Thank you, Jeff.
Yes.
Strong point, right?
yeah, and you
Okay.
will tell them before you close, but it is not. You don't need to tell them until well in, right? So,
Right.
so
But it doesn't have to be in the contract that you're going to do a 1031?
It does eventually, but you can
I got
modify
it.
Okay,
You
so,
can modify it after due diligence at any point
Hey,
after
this
you
is a part of
negotiate
a
it.
1031 Yeah,
Right.
this is a part of a
Don't-
1031 exchange. 1031 specialists are a qualified intermediary, and then we do an assignment language because we need to be a part of the transaction in order to satisfy the IRS rules and
Right. The
regulations.
big mistake is to tell the broker right away, and when you make the offer, you're in a 1031 because you just lost your negotiating power. You could always put it in once you negotiate the price, after due diligence, before the end of due diligence. 100% understood. Because once you agree on a price, they're willing to change. Hey, by the way, I'm going to do a 1031. Can we do an addendum? I've done that myself. So
100%.
Okay, rock and roll.
Yeah.
I'm glad you brought that up.
Yeah.
So let's go to that reverse
Reverse
1031.
exchange. So by and large, people do forward exchanges because you can use the money from the sale of your property toward buying the replacement property, and so that's the liquidity that people utilize to purchase the replacement, right? So in a reverse exchange, they call it that because it's the reverse order, and all of this is governed by safe harbors with the IRS. So this is not a risky transaction or a risky tax position. This is all done in very commonplace. You purchase the property that is your replacement property first. So instead of, if you own a duplex you're selling to go buy a single family rental, and you decide, look, it's hard to find single family rentals, I can go buy the single family rental first. You need to do a number of different things on the structuring side, which are maybe beyond the discussion here, but it's very commonplace. We have standard documents and procedures around it, but you go buy the replacement property first, and then you now will be in control of both properties. And so you buy the single family rental, and then the timelines are the same, where you have 45 days to identify what in your portfolio you're going to sell, and then you have 180 days to close in your portfolio what you're going to sell. And then when you sell the property that you've owned already, you will use that money to effectively pay yourself back for the purchase that you did of that replacement property already, right?
Same timeline, though. So you have
Same
45
timeline, actually,
Right.
but it's a little bit different, right? Because you have a lot more control when you're selling, and again, not to say that you want to go start slashing price to go generate demand, but you do have more control on establishing a timeline when you're controlling your asset. And so in markets like this, the one thing I would say as a big caveat to reverses is, more often than not, people have the liquidity to go do it all cash when they do reverses. In general, financing is a little bit, you can't use like regular agency debt or bank debt for reverse purchases while it's in that exchange timeline. There is financing, but it's more expensive. It's more challenging. So most people who do it will do it all cash. And then when the transaction is all done, you can get regular, bank and agency, regular sort of mortgage product that will
do the refi or
exactly.
Right. So okay, so just if I'm talking to a 5-year-old, right? I have $1 million property that I'm going to sell, and I know I'm eventually going to sell it. I go out and identify the property I want to purchase first. I'm a cash guy because it's easier. There is tricky nuances in financing, and if you find the right bank, maybe they can agree to work with you. Have you ever seen that? I have. Yeah, right. Like I work with a lot of credit unions that are kind of nonprofits, so they can do things that other banks can't. I'm sorry. So I get that. So let's say I buy that $2 million property. I lock it in the contract, but technically the 45 days start on a reverse after I close it. Yeah. It has to close, right? So when you buy the property is when you're when you buy the property and the property transfers, that's when your reverse exchange timeline starts. And now you have 45 days to identify which of your portfolio you're going to sell. Let's just say it's one property that you have, and you know which one you're selling. Most know which one they're selling, even if they have a portfolio. And so you basically identify that one, and then you have 180 days to get that sold. And then obviously you had to come up with capital to buy the property that you bought first. And then what you do is you use the money from the sale to effectively pay yourself back for the money you used to buy the property. Understood. Right. So you could technically buy that $2 million property. Let's say you have $500,000 in the property you're going to sell, right? And that's your exact down payment on a $2 million new piece of property that you purchased first with financing, 25% down, right? Sure. And then you trigger that. You say, I'm going to do a reverse 1031. So you had that $500,000 in cash, whatever, sitting in the bank. Now, I get it. It reverses, right? So you follow the same procedures. You reach out to Jeff first before you do this. They'll walk you through it all and so on. And then eventually when that property sells after the timeline, you just put your money back in your bank account, right? Right. So, exactly. Right. Yeah. So I see some benefits there because you're not under such massive pressure, right? Yes. Or if you find the right deal to buy that's, higher, right? And so me as a mindset, I think about the equity I have that in my current properties, right? Yeah. And I'm like, okay, with that equity, if I can right now shop for deals, and with that equity, I can buy it, right? And I have the cash in the bank, then it gives me some more time, right? So not everybody's got that. Especially in markets like this, right? That's the constraint that most have. That's the constraint, right? And it requires a little more structuring, just so everybody's aware. But I will say to you, like family offices who have very large portfolios and access to cash to do individual purchases on some basis 180 days in advance, and that is a particular constraint. Particularly in markets like this, it's very popular, right? Because you can the harder in other markets, it's harder. It's easy to find the replacement property, and selling yours is the hard part. And so you may consider a forward as the better methodology just to maximize the timeline dynamics that you have. Right. So our client base here at Premier is anything from, like somebody who's a brand new investor, right, coming out of a mastermind that referred one of our agents, all the way to we deal with syndicators, institutionals, we deal with REITs. So I get it. When you're a family office, you're sitting on a lot of that cash. It works. I mean, tax strategies are super fun, right? Because I would just say, and just to let everybody know, and again, part of our mission at 1031 Specialists has been to educate average investors, which I know you're definitely calling out inside of our discussion here. This works for average investors. Like I would just say, this works. It is not expensive. It is very doable, and we're helping average investors who have some property or inherited property or smaller portfolios all the time. So it does make a difference, and folks who are using it successfully. So I would just say that is something worth mentioning. This isn't just for that family office with a $200 million portfolio. It really is for, hey, I've got one investment property, and I'm going to have a material gain. It really does work. What's the biggest mistakes you see when around 1031s? Yeah.
my view around the biggest mistakes I see are folks getting not contemplating it early enough. So, I mean, I'll tell you, I had a guy who does a lot of commercial real estate transactions as a broker from a very notable firm call me a day after he closed. And there's no doubt, I'm not even kidding. And it's
right.
And he's like, "Oh, I thought there'd be some workaround," and I'm like, "There truly isn't." And so the point is the planning is really everything. We don't like when we work with clients. Our whole business model is set up to consult and talk with clients and help them identify their issues and things they need to consider. And I don't charge by the hour. Like, we're here to help clients, and with the goal is if they do a 1031 exchange, they'll think of us, or and maybe we can be of help. So to me, the biggest problem people run into is that. I think also folks, they underestimate, like if they're trying to do certain more. For example, if you're invested with partners, this happens a fair bit, and you're in a partnership that owns property.
Okay,
you need to be more cognizant of how you do that, because there's something with 1031 exchange called the same taxpayer rule. So the person who does the actual exchange or who sells needs to be the person who buys, and that person, I mean the entity. So either a corporation, the partnership. Most times it's the individual, and keep in mind a single member LLC will be a pass through, so it's to the individual. But if you're in a partnership and the partnership owns, or you're trying to buy a partnership interest as your replacement property because it will own a property, there's considerations there that are very important to deal with beforehand. Because if you sell your partnership interest and buy a piece of property and it's done in that way, and I'm sort of paraphrasing this, it would get disallowed by the IRS. So
that's a great point, right? So we have a client right now, right? He's got a 188 unit, and him and his partner are, whatever. They're having troubles. I think one of the partners going through a divorce. He needs liquidity. It's a property they've owned for 8 years, and this is their only property that they own together. The one partner who's going through a divorce, unfortunately, he wants it sold. The other one's like, we have too big of a capital gain. Right? I don't want to sell it. So they're trying to buy each other out, but they've put it on the market for sale. So what you're saying is, let's say they have $1 million capital gain. So the partner that's staying in real estate, can he still 1031 into another property, or just for his portion of the equity and the capital gain?
Yes.
Or, okay.
They definitely can 1031 exchange. So that's not an issue. My point is that if you are partners and you're not tenants in common, you are just partners in an LLC. And the LLC, and we're going to get into technical elements. It's not so much about the technicalities, just to say that if you have partners and you're considering doing a 1031 exchange, these are considerations that you should just be looking into before you do it. Just like for them, how is it owned? How does it need to be owned to make sure that I own a real prop? Either the entity needs to do the 1031 exchange, and then they can figure out how they work with their attorneys to carve up the proceeds, or change how the structure is. And again, there's a whole industry of folks who are including us, who can help you identify the issues.
When it gets complicated, is let's say the two of them want to sell, and then on the new buy they want to bring in a third partner, right, for more equity. So all of this is possible.
It's
but
all
again,
doable. It's not a problem. It's just what happens is folks just do the deal and then don't consider these elements. And before you go under contract for issues like that, it's very important to have at least talk. I mean, we'll give you sort of we're happy to talk with you about it and help you issue spot. And then we can let you know, hey, you definitely should be consulting with sort of a real estate attorney on this metric, or hey, no, we think, you're in a spot where you got a pretty straightforward, clean way you own it. It just, these are those two things I would say of engaging us early and on the timeline, and then it's just so common that people pool capital together to own interesting properties that those things matter a bunch about just making sure you cross your T's and dot your I's to execute.
No, 100%, right? And by the way, anybody who's listening out there, right? Obviously, we're putting this out here for real estate investors. So whatever takeaway that you're getting from Jeff, from myself, put it in a comment below, because we may not hear something, or you may know a strategy that we don't, because this community is about helping each other. And you can always reach out to me at Jerry Katz CEO all over the internet. And also, Jeff and his co-founder, they've built a platform where I've never seen before for 1031s, right? So if you go on 1031 exchange or whatever you're trying to look at, you can't find information. This was an industry that your accountant's friend was a 1031 exchange agent, right? And if you go to 1031specialist.com, their site, everything's there, right? There's information, there's education. And by the way, they've also scaled it to make it affordable, right? Meaning, like, my 1031 agent in the past, I didn't know how much they would charge me. And I didn't even know where to find another one. I had to find another real estate investor to try to find another 1031 agent. So they've done all this work for you, right? You can reach out to them, send them an email. They've automated it. Their AI can answer 10 of the questions, right? But so the easiest thing to do is just go and reach out first. So with that being said, because Jeff's an entrepreneur, his co-founder's an entrepreneur, tell me about when you guys came up with the idea and what you're doing to build 1031specialist.com. Because when I first heard it from these guys, right, because I know them through the entrepreneurial world and YPO and EO, I was like, holy crap, what a great idea for a roll-up. I love niches, right? I deal with high net worth commercial real estate investors in high risk coastal states, and I increase their NOI by lowering insurance expenses. Tell us the story, Jeff, because when I first heard it, I was like, wow, go for it.
Well, I'll try and make it a shorter version, but of a long version that I'm sure you guys will appreciate after. But a lot of my best ideas and the best things, first of all, my co-founder John and I have been decade-long friends. We both grew up in a similar world, Wall Street, et cetera, and been investors our whole careers in all kinds of different things and a lot of real estate. So he and I have been friends and always batting things around and working on something. We were working with a venture capital gentleman on a big idea around the 1031 ecosystem. My father's a tax attorney. I'm a CPA by background. I started my career at Ernst & Young, so I was very familiar with it. I actually had financed folks in some different niche 1031 platform things in my past when I was on the investment side. And so I had unusual familiarity with the whole space. And so there was a very large idea working across the entirety of how 1031 investors buy real estate, handle real estate, finance real estate, and get access to capital, et cetera. And so I was helping work on that project. While doing that, we started working with a lot of qualified intermediaries just to sort of diligence and understand what was going on. And that's when John and I realized we can be extremely effective in doing this business. It's a business that hasn't utilized technology in the way it can. It hasn't shared the message. It hasn't educated consumers. It doesn't serve clients in the way we think they should be served. And so while we were working on something that was an adjacency that was incorporating this industry a number of years ago, we came to the realization that we should be doing this and really serving individual clients, of which I do today, right? I talk to clients. It was a big desire of mine to, on this second act of my career, really re-engage with clients again on this level, because I was doing a lot of institutional investing for a period, and it's been great. And so that's what we embarked to do. I would say we are the most knowledgeable out there of the ecosystem that we live in with respect to this niche. Niche is, I think, a fair comment. And so we've been growing the platform. We've been bringing on talent to, realizing that, hey, to serve our clients even better, there's different pieces that we should have in-house. And we've been doing that, and really proud of the team and platform we've created, and different places that we see that folks don't have what they need. We've built it, right? And so it's all on the website.
No, I see it. Yeah, no, I saw it. So some interesting things that you guys told me. How many 1031 agents exist in the United States? An agent, by the way, is somebody who is a fiduciary with a specific license, by the taxing authorities and so on, to conduct 1031 exchanges and hold your money in escrow. Because if you're not familiar, you do the 1031. Once the closing happens, it gets transferred to 1031specialist.com or Susan for me, and she holds the money until it's deployed on the new deal. So it's a fiduciary responsibility. They're licensed, and there's not a lot of them. How many are there in this country? I was shocked when you
There's
when
only
you
a
guys
few
told me.
hundred. So there's a few hundred of us who do it, and there's people who do it who are really, really small time. But my view is you want to be working with someone who has an institutional flavor, has insurance, has structure around how they do things. And so, yeah, it's a pretty small group, but something that we think is ripe for someone like us to be a little bit louder on how we educate and get out there and tell people what
so
they
can
do.
you imagine how many we have 3,500 real estate investor clients, okay, and there's only a couple hundred, and they have the exact number, they told me, right, of exactly how many 1031 agents can actually do this and are licensed to do this with the correct, insurance and E&O and all that stuff and education. Can you imagine? Thousands of investors, thousands of buildings, and only a few hundred agents. Now, why? That's an interesting question. Why is there only a few hundred? What's your best guess? Because you're way smarter than me, Jeff.
What's my best guess? My best guess is it's pretty niche in what it does. It's very specialized. So, I would even say, for example, it's not uncommon that your CPA will not be super duper well versed in 1031 exchanges because it doesn't happen every day, right? They'll be super knowledgeable in all these other tax strategies that happen for all their clients, but not everybody has clients that are using that. So it's very niche, and it's not that well known that folks do it, and that this business exists, and so it's stayed under the radar because of that dynamic.
Is there not enough revenue? Is there maybe not enough?
There's a ton of
revenue?
There,
that's what I thought. Right.
Yeah, I mean, there's a lot of money that rolls through these several hundred, right? I mean, as you said, so roughly 1 in 6 transactions is a 1031 exchange. So if people want to understand how often it's happening a lot. Okay, so 1031 qualified intermediaries like us are on a lot of transactions a year, a real lot. It's just very niche. And so, I don't know, it just sort of has fallen into this category. And it's partly why we've built what we've done is we sort of agree with your assessment. Why isn't there more innovation?
Right.
There's a lot of, I'll give you this too, okay, Jerry, there's a lot of folks who started these in the 90s, late 80s and 90s. A lot of the ones that exist today got built.
Right.
And so there was a wave of people recognizing it, and it had to do with how 1031 exchanges in the 70s sort of modernized how the structure works. And so a lot of folks started them, and that is still the firms today, and that's partly why it sort of has the culture inside of this niche that it does. It's a bit sleepy for folks who aren't us. And I think there's some just dynamics around the demographic.
Right. I always say, what's kind of one definition of an entrepreneur is to understand a certain market and look for the inefficiencies or the arbitrage play and then execute on it, right? And that's the biggest thing. 3,000 people could come up with the same idea, right? And people are afraid to share ideas, but that's a bunch of baloney and bullshit, right? Because if you come up with a good idea, they say 3,000 people come up with that same idea, right?
Bingo,
Here's the
Jerry.
problem. One doesn't do anything. The other guy or girl tries, fails, and the third executes, which is Jeff, right? And succeeds.
Well, I will tell you, I agree with what you're saying 100%.
Yeah.
I've dealt with a lot of venture capital in the past, and I really, people are really. Originally, everybody was, I had the idea non-disclosure agreements. You see my idea, you're going to steal it, and what I've realized in my life is recognizing the idea. To your point, is part of it, but 95% of it's in the execution, right? The execution, the capital, the
100%.
performance, all of that. So
it's the execution.
I totally agree
100%. It's so funny. We had another guest on this, and he's like, listen, we can underwrite real estate. AI is going to be a knowledge base. It can underwrite. It can do this. The problem is execution. So I said, what's the real estate business about? He says, shoe leather. And I said, what? And this is a guy with $350 million in assets, right?
Okay.
And I'm like, shoe leather. He goes, if you don't get out in the street and do it, you can't be successful. I don't give a shit. That's what he said, right? Because with shoe leather, that was his secret, meaning execution, right? That was the metaphor, and so on, so forth.
Yeah.
So I love it right? Because what you guys have done, because I love entrepreneurship, I love all that stuff. I know that you guys have done some acquisition. I know that you guys, they have people throwing capital at them, right? And they're going to, disrupt the Susans of the world and things of that nature. So that was really cool. Did you guys did you did an acquisition, right? You did some kind of a roll-up strategy?
Yeah, we've done our first acquisition, which has been really great. So we, more California based, we've been operating in, out of Denver primarily to start. We do things all over the country. So we have people and presence in, in all the major real estate markets. This one was a really interesting folks looking to transition the business because they were at retirement age, and we got to know them. And it's in an area that I am based, so it made a very natural progression. And they have a long track record of performance. And we thought, hey, this could be great to do some of the new and cool things we're doing, which their business wasn't doing. And we think we can really energize that business 100%. Even more. And it's been great, and so that whether we do that again or we just continue growing through bringing on talent and building our relationship base, only time will tell. But yeah, our goal is to be the best, and whether that's the biggest or not is not so much the case. It is to be the best, and
I have a feeling you'll be both. I mean, and honestly, right? So like they talk about the demographics, right? The baby boomers, right? Which are the ex-hippies from California, right? That's really what happened. And then they're all reaching retirement age, that whole thing. They were the generations of entrepreneurs. So I always hear about there's going to be so many businesses for sale, right? It's that time. And then the next generation is not always entrepreneurs, right? The kids and so on and so forth. I'm a son of a baby boomer, but still, the point is this is exactly why this niche was ready for acquisition, disruption, modernization, because those folks aren't going to do it, right? But you're going to do it.
They're definitely not going to do it. They're not going to do it.
They're not,
and they haven't done it, right? So they've been doing it. Many of these companies have been around 30, 40 years, where someone has a really nice, great little business, and they have a great reputation. They do good service for clients. They could do more like what we're doing, but as far as execution, it's good. And look, we want to be the opportunity where there can be a nice transition, and they can get something out of all the goodwill and loyalty they've built, and we can be somebody who helps them in something they're trying to achieve in their part of their life. So, if those present themselves, we'd love to be there to talk with them.
Love them. Love it.
I want to take a quick break to ask, did you enjoy the video so far? If you want to learn how real estate titans make millions, hit that subscribe button now. Join us on Real Estate Profit Boost with Jerry Katz at Jerry Katz CEO for expert tips and insider strategies to grow your wealth.
So curious, valuations, right? Are these considered do they trade at valuations of an accounting firm or a CPA firm? Is it considered a recurring revenue kind of thing, or valuations, or is it another opportunity where people don't even understand what these businesses are worth?
There's not that many transactions that happen because, as we talked about earlier, there's only, in the hundreds of them. So it's not like it's a liquid market. So, and I would say, in general, it's not it depends on the dynamic of the firm. But for one that's smaller, that is got a nice embedded base but doesn't have much growth profile and has some key man or woman dynamic, it's hard to command large multiples for those smaller companies. Obviously, if you're on a platform like ours that's doing a lot more things and sort of on a growth trajectory like we are, then it's different. But as far as valuations, without getting into specifics, it's very liquid. It's where the buyer and seller would negotiate. There's a lot of factors that would go into it, but it's hard in general because this is a service business. This isn't a collateralized business. It's not a real. There's no hard assets. It's the relationships they have, and it lives with the people who've executed on that. And so there's risk and dynamics associated with that.
Right. It's almost perfect for organic scaling, right? Because you're going to disrupt it, right? So to give you guys an idea, Jeff, what if you go to the portal, what do you charge for a 1031 exchange?
So for, again, we've also modernized how we charge. Like inside of real estate, I think just my experience is there's a lot of there's just a lot of ticky-tack fees that just keep adding up over time that you see on your closing statement or that you see on an individual statement that you get. And I'm sure everybody can resonate with that. Our view is to go with just one flat fee. So you won't find any new different fees for us no matter how much you call us or how much we do. And so for a forward exchange, we charge $1,195. And then for us, we're the only one that we know of right now in the industry that if you, for whatever reason, you don't do a 1031 exchange, like you embark on it, but you just decide, I have reasons why I'm going to take the money off the table, and I'm just going to just pay the tax in the normal course, we give you your feedback. So that's what we charge. Yeah. So, obviously most of the time folks who are embarking on 1031 exchanges see the big benefits, but we don't want to just disincentivize anybody from embarking on it, and we don't want you to feel like, if I do this and then it doesn't happen, like I'm out my $11.95.
I mean, listen,
and we get paid at close. So when you call us and you sign up with us, we don't charge you anything. There's no hourly that happens. It's just one flat fee, and it comes out of the proceeds of the sale.
Right, $11.95, 1031 exchange. They get paid at close. Otherwise, there is no payment. You get the fee back. And then number two, like I've dealt with agents, they do it proportionally, right? So it doesn't matter if I'm selling a $300,000 asset or if I'm selling a $50 million asset. It's the same fee.
Yes, same fee.
Wow.
I mean,
interesting.
Part of it too, keep in mind, Jerry, is that it is it's roughly the same work, interestingly, to do the really big transactions as the small transactions. Obviously, there can be complicating factors, but by and large, our job is the same, and we look after a client with $200,000 in equity the same as we would one with 20 million, and so it's the same fee for both.
So you guys hear that? So one of our core values is always create win-win situations, open and honest communication, right? And I can't tell you how many different service-based businesses around real estate, like 1031, specialists, or, there's a lot of them, right? For CPAs, from legal all the way to, cost segregations, right? And I have some with this man's integrity, and others, right? They charge on a percentage of savings, a percentage of the 1031 savings, a percentage of the cost seg. It's a 40, you know what I mean? So he said it. Why? Because he's open and honest and he's real, and that's why he's on our show, because he's like us. It's the same amount of work if it's $50 million or if it's $50,000, right, on a small investor in Kansas, right, and so on. So what you guys probably don't know is the revenue model. Jeff, tell us how you can afford to not charge somebody, have a flat fee, and do this at scale and deliver better quality, better education, right, better execution, right, than this. Why? Where does the money come from? What's the revenue model for Jeff?
Sure. Happy to share. So with respect to the money, we don't hold the money very long on average. So, and the investor controls how fast these timelines exist. For us, it's actually pretty short on how long we hold on average for investors. So if we have 100 clients, I don't hold money very long because a lot of folks have their exchange lined up. They've done all the preparation, sort of follow some of the things and advice I've talked about. So we don't hold money very long, but that very short period of time, there's interest generated on capital that is held, and that interest generates some level of revenue that we can earn. So that
you
is
get that, guys?
That's part of the business.
Right. Again, so what you think at business is sometimes, he's charging $11.95. That's his revenue model. If I can do 1,000 of these a month, there's my revenue. But it's really not. There's a backside here, right? That they're sophisticated. So if Jeff and 1031exchanges.com is doing, I don't know, 100 a month or something like that, it could be a $50 million one, or it could be $1 million one, or it could be a $300. Think about the capital that he's holding. He's holding I don't know if you want to share numbers, but they're not a small company.
I'd rather not share the exact numbers, but, a huge part of our business is the efforts that we have to safely and securely with, the most, what do you think, forward-thinking methodologies and structures with our partners on how we hold that capital, and it's all segregated, and we do that in a way to make sure we protect folks. But yeah, we're definitely holding a material amount of money.
Right, and they have a fiduciary responsibility to separate it, just like an attorney or an escrow agent, just like us with insurance. We hold premiums before we pay out to our carriers, right? Separate account, fiduciary responsibility. But we have the right to earn interest on it if it's sitting in an account. We're not deploying it in investments, and I'm assuming you're not either, right?
Yeah.
But we're earning interest, right? So he could be, and I'll throw some numbers at him. He could sit on $100 million and make 4%. He can sit on $1 billion and do it. So there's a revenue model back. So you just got to think a little bit out of the box for these opportunities and so on. So again, if our audience, share this, right? You're going to find links in the description. If you like something about this, tag it. Post it, make a comment, share it with other investors. If you're in a real estate mastermind, you don't know about 1031specialist.com, and you don't know what Premier, my company, does. The point is integrity and honesty are values, and that's the only people I do business with, people I do business with who share values and views, and that's who comes on this show. Sooner or later, we'll bring somebody who's crazy on, you'll see the difference. And how greedy they are, or something like that. Okay, so Jeff, I'm going to give you a quick lightning round, right?
Okay.
Just because you got so much stuff, right? So let's pick your brain, right? Because you're a smart guy and stuff. So where will interest rates be 24 months from today? 12, 24 months, what do you think?
I think roughly the same place they are today. That's what I think.
Yeah.
Okay, so I think for investors who want to really think about this, you can look it up on the internet. There's something called the forward curve, and that there are people making extraordinary levels of bets on interest rates in the future, betting on the forward rate. And you can look at options for how much embedded volatility there is in that rate. So people think like, oh, it could be 1% or it could be 12%. What I would tell you is it's extremely remote that those things are going to happen. And because the people making wagers on that, which you can do with financial instruments, are saying it's extremely remote. So I think for me, as I think about how to, folks trying to speculate on that, I just, as somebody who used to, part of my career for that 15 years at the hedge fund was we did a lot of rates related investing, which is exactly this, and options on rates and all kinds of different interesting products. The steady state for me feels very comfortable. I think some of the inflationary dynamics that exist out there feel very embedded at the moment. And short of a very large recession, which I think is the main reason you'd see a big move, which my bias is the rates go lower if I were to make a guess, it'll be where we are today.
So 24 months where we are today. How's that going to affect the volume of real estate transactions?
I think volume of real estate transactions stays very muted for a longer period of time than people think. That is my current view. So
wow, very interesting. We've seen a big slowdown from 24 months ago, right? Huge. Do you have that percentage? What's the number of real estate transactions?
We are in the slowest period of pending sales, I think, since the great financial crisis. So, and I think it maybe pierced through. So we are in commercial real estate transactions. They're down anywhere from 35 to 70% in volumes. It depends on the multifamily is doing a bit better than in certain other asset types than say office, right? And office has its own unique dynamics. But it is the main reason it's slow is that you have rates that go up, right? From I could have financed a deal at 4% a couple years back, right, all in, and now I can finance a deal at 6 to 7.5%, and the cap rate I'm buying something at is at 5%, where the seller wants to get paid, and otherwise isn't going to sell. And so there's this very unusual dynamic, these sort of negative leverage, quote unquote, deals where you borrow money at a higher rate than what the property actually yields in profit, which is a very unusual and generally not sustained dynamic. And so if I were to make a guess on how that moves is that rent inflation sort of makes its way through the system a bit so that cap rates can expand a bit without the price going down. And you sort of get to a dynamic where that 5 cap feels like a 6 cap in 2 years. And that person is okay selling at a 6 cap because the actual price of his property is at the same or higher as where he was. And so now things can start moving easier. That's my prediction.
So where does the rent inflation come from? Because it pivots on that, if I understood you correct, right?
Where does the rent inflation come from? I'm going to make a broad comment. Inflation is an insidious little animal. And I have invested globally in my career in areas that have inflationary dynamics that are far less stable than here. And what happens is inflation in some circumstances begets inflation, and especially no one's on a gold standard or everything else. It sort of like becomes like I'll call it like a very philosophical thing, because no one's really pushed the envelope like we have in the last 50 years with this grand experiment of massive deficits while you're not on a gold standard. Okay, like
Right.
we're digressing a bit, but it is possible that because people's wages are going up, and you see it where I live in California, people's wages go up, so what
Right.
they can hire at a restaurant goes up, and so then they move the food price up, and then
Got it.
it sort of becomes its own self-fulfilling thing unless there's forces externally. And I'll leave you with one last one for your investors is what has happened in the last 25 years, I'll say more, 35 years with globalization and the internet. And look, maybe AI and robotics will be the next boom. So let's just hold that off for a sec. But with globalization and the internet, the massive productivity gains that allowed people to do inflationary policies without inflation going up because of how much more efficient we got with our time
Got it.
was a massive thing. And maybe we're hitting the end game, maybe we're not. I'm not sort of a doomsdayer on all this. But
It's
rents go
tough.
up because people are making more money and they want the place to rent. And if they're making more money and they want the place to rent and it costs more to get food, then you have to make more money, and then the businesses charge more money. And it sort of becomes this thing without tightening fiscal monetary policy that can spin.
Right. No, 100%. So, for example, here in Florida, right, in the last, 24 months, we've seen rent retraction, not inflation, right?
Right.
But you could, I'm assuming, listen, the printing of the money during COVID and everybody moving to Florida, the demographics, I mean, our rents went up 35%
Right.
in 12, 18 months. So today,
I think you got to normalize the rents, and I think you also have to normalize there are going to be just market dynamics. Sunbelt multifamily went through a massive building boom where everybody was building into the face of these rents going up. Rents outperforming, and I'll call it like real rents. So like the amount that rents go up above interest rates, like it shouldn't go up by double digits on a sustainable basis. So if you go up by 45% in a market in 2 years and it comes back by 10%, you're still up 35% on a 3-year basis. I think there's some normalization that has to be looked at there. And you need to look at the supply and demand of product in markets where, again, the whole smiley face of the bottom of the country had massive multifamily expansion.
Right. No, 100%, 100%.
Yeah.
So going forward, right? Like if you've obviously been investing in real estate for years, how do you, what's the best way to phrase it? What's your, what's the word? And then we'll edit this piece. But, so you've been investing in real estate a long time.
What's interesting to me?
What's interesting, but not even that. What's your strategic edge, right? Because in the future, and then we're going to bring that back, because if you got something interesting, I want to hear it.
I don't know.
So,
I don't have specific, but I have themes that I like. So
okay, but for example, I believe that AI in the future is going to level the knowledge playing field, right? It's going to be a commodity. I've already got the most sophisticated underwriting spreadsheets that Blackstone uses uploaded into a super agent. I can plug in everything from demographics, population trends, all of these things, right?
Yeah.
And it pumps right out for me, literally, in today's technology world. Right. Yes, buy this at this price, at this cap, with this debt, and this, right? And it's done, right?
Right.
So what's going to separate us in the future, right? Real estate investing, besides how much capital we have and how we operate and execute. But the point is what are 2 or 3 differentiators that you've used as an edge or a strategic edge in buying real estate over your career or picking the right investment?
Well, it gets into scalability of it. Okay, if you're Blackstone with $100 billion in a fund and it needs to deploy and it's raising another 20 on the follow right behind it, and you have to have scaled ideas, is very different than someone with a $20 million tactical portfolio that is going to get hyper micro on what's going on in an individual town, area, little investment dynamic, who's doing what, like get really knowledgeable with local city council and what their goals are and what they're looking to accomplish. We have as an example, we have a massive government building with a huge amount of land. That's a huge infill project where I'm at that has massive acreage, and there's going to be a whole thing that happens there for hundreds of millions of dollars. So what are the knock-on effects? Like, obviously the first wave of valuation moves, but what is that? How does that change the way that area behaves? How do people move? How do they behave? Where do they go? So I think those are always really interesting, and that's why real estate is such a fascinating and opportunity-filled area, and the fact that you can get so much leverage on your capital makes it to where you can make such a fantastic returns. But yeah, that would be my sort of reaction. It's harder for the big guys, is my reaction.
It's much harder for the big guys, right? So the smaller guys. So what he's saying is he's looking for the rock that just got dropped into the pond, right? As a metaphor, right? So if it's a government building or a local city council, and there's, they're doing something, they're changing something, a law's changing, they're doing a large development, government, whatever. That's the rock that just got dropped. And then there's externalities. The ripple through the pond or the lake is the wave that he rides, because it's a more cushioned investment. Now, like a Blackstone, they're buying the Panama Canal, right? Okay. You saw that one?
Right.
Yeah. Okay. So it's harder for them to scale. But as a mid-market investor, 15 million to 100 million.
No, easy.
These are the opportunities, right? That take place, right? Or, if you take it down to a micro level, it could be a new Walmart distribution center or a new factory because of our new tariffs, right? Honda announced they're building a new plant. Well, think about the multifamily. That's the rock where and you can do it. So there's always a way. I love that strategy, right?
Because it's still an inefficient market because things don't happen in real time like they would with like treasuries, right? If you traded treasuries, everything's happening in real time and everything's priced for perfection. Real estate is things happen in slow motion. People know things that others don't know. It's not a security, so there's no illegality in that. There's knowledge that you can have with the amount of effort and relationship building and networking, which Jerry, you're a master at. So these are the things that create returns, and why you're doing what you're doing is great.
Listen, my strategy when I moved to Florida was I say economists are wrong 50% of the time, right? I'm an ex-Wall Street guy. I'm like, they're wrong 50% of the time. But in my experience, demographers who study demographics and people movements and things like that, right? Migration patterns, workforce ages, right? That I like. So that's the tidal wave, and I'm not the best surfer, right? But anybody who rides a certain demographic wave, there is an opportunity. And that's exactly what brought me to Florida in 2000 after the tech bubble popped. And that's exactly, I would love to, between you and me, I wish I lived in California, right? I love the landscape, the ocean, this, but I'm not doing it because of what's happening there with demographics and people leaving and things like that.
Yeah, tons of headlines.
But the joke with me was like, where's Jerry? 2004. He's under the courthouse steps. He just got another deal. The city's repaving that road and adding 4 lanes, and he just bought all the retail on the side. I did exactly what you're describing.
Yeah, I mean,
right?
That's smart investing. I love that.
And I love it. Awesome.
Yeah.
Real investors are using this boost to boost returns. Real estate profit boost. So why aren't you? Watch now. Click below. So another question. What do you think? You mentioned gold reserves and gold standards, right? Right? Yeah, I love this kind of stuff, right?
Yeah.
One day we'll do like a Patrick Bet-David style podcast, right? Where you notice that all these entrepreneurs are now going political, and they're coming out with their own media channels, right? I know this is way off topic, but that's what they're doing. It's crazy. So what about here's another lightning round question. Where's Bitcoin going to be 12 months from today?
I don't love Bitcoin personally, and I would say in general, real estate investors are, my experience at least, they like things that fall on their foot, and when they do, you say ow. So I've been wrong on Bitcoin all the way till today, and so I'm definitely not the person to listen to on where it should go. I just have a fundamental view personally that governments have very little interest in having independent currencies that are out of their purview control and otherwise, and they're the ones with the guns, that there is a point in time with which the Super Bowls, this is my personal opinion, and again, do not listen to me on where Bitcoin's going, but for the Super Bowls, I think there's a point at which where it becomes usable and very, very, I'll call it liquid to be your currency, right? And I'm sure people who are very involved with Bitcoin will debate me on whether that's the case. But when I go to the coffee shop, they want my Apple Pay credit card or cash.
Right.
That is where I don't think governments want it to be. If I'm the United States and I'm the Treasury, I've lost control of my own monetary policy, and I don't think they're interested in that. Now, the bulls would say that's exactly
Super
why
smart.
it's going to the moon, is because it's going to go that way whether they like it or not, and then my responsibility, they're the ones with the guns. So
Right.
I don't it's not a sophisticated answer other than it's the reason
I get it, though.
It's the reason
Yeah.
everybody around me's made a ton of money, and I just I'm focusing on what I'm focusing on.
No, I get it, and I love your
haven't been in
response.
it, so-
The reason I brought it up is because
Yeah.
you mentioned the gold reserves, right? And what's going
Yeah.
on, and their Bitcoin reserves. And by the way, Grant Cardone just started his first real estate Bitcoin fund, right? So he
Awesome.
so he did a $100 million raise, and he bought $80 million worth of real estate, right?
Okay.
Bricks, and then he added $20 million in Bitcoin into it and did a $100
Yeah.
million raise.
And again,
now
I have
the
no problem
cash
with
flow-
folks doing that. Yeah, I have no problem with folks
I
doing
just
that.
thought it was
Yeah,
interesting.
And again,
but again,
I don't have a view positively or negatively. Just for me personally, it doesn't fit into what I'm doing. I would
Me
say
too.
gold has a far different, longer track record and
Right.
tangible scarcity to the average person. And just as an aside, has a global reserve dynamic that is,
Agreed.
I think, a different. It's a different play. They aren't interchangeable in my opinion, but. Again, I have no problem with people being really excited
Right.
about it, and I get the merits of it, actually.
And this is why I go back to the economists are always 50-50 wrong, right? Okay, why? Because
Yeah.
there's people saying we're in a gold bubble, right? Gold's almost at $3,000,
I know,
right?
yeah.
So it's interesting and so on. Okay, a couple more quick questions. So you did a lot of real estate deals. What was the most unique or strategic aha moment for you on a real estate deal that you came up with a new strategic way, a new plan, and it worked and it was successful?
I would say a slightly different version, just because it sparked my mind. I got involved with a very large transaction that was anchored by attendance to almost like, so it was a very large youth sports anchored, and I mean very large, like multi-100 million, to where it had created all this demand for attendance. And then it became a very operationally intensive piece of real estate. Whereas, if you have multifamily, it has certainly some lease up and other operational dynamics. But this was an operationally intensive piece of real estate. Really, really compelling. Has huge things that I fundamentally believe in. But I would say a realization there is very much appreciating that not all real estate is created equal. If you don't have as you get into more and more operationally intensive real estate, how you manage that, who you have on your team, and not that team doesn't matter, but I could make an argument that a lot of real estate transactions, team is less relevant than stuff that has a very entertainment-driven, like experiential dynamic. And if you get it right, there's a massive pot at the end of the rainbow. But I would say in that example early on, which I was involved with in a major way, and ultimately did a lot of it myself through time, I realized, wow, there are situations inside of real estate that are very, very important to all the multifamily we were building, to all the retail we were building, to all the mixed use we were building, that if I don't have the hole in the middle of the donut with incredibly, incredibly successful talent that already knows how to do this and can generate what I needed to generate to make all those other come alive, it's really challenging. So that was something that was an aha
100%.
moment of the talent matters in real estate, I think, more than is given credit for. And I've respected that. I always did, but it gave me a new, okay, who are the people involved with what's going on? And I've taken that across anything I look at and think about of how are we going to execute on this, and who are the people doing that, and what are the track records associated with it.
No, 100%, right? It's like people underwrite let's say you want to be part of a deal as an LP, right? They underwrite the deal, but they don't underwrite the GP, right? The talent. So for me, the biggest challenge, right, that most entrepreneurs that I come across say, How do I build a team? Where do I find my talent? How do I get sophistication? And in the world that I know, like if you ask, what's your biggest challenge? Like I can't find the talent, right? Yeah. Have you found a solution?
I laugh at that because
it's hard.
There are no quick fixes. There are no quick fixes. It is earned talent. Talent knows, like, if it's good talent, they're discerning. They're running their own business, which is their own talent. Okay, now they maybe and so you have to earn that. You can't just get it. Obviously, there's numbers people will respond to. If you throw them enough money, but honestly, my experience with good talent is, even if they know you have the capital, if they aren't coming into things set up for success, or they don't think they can drive it themselves, they won't do it anyways, even if it means like a game-changing level of money. And that's with the good talent. And then look, we're dealing with that with our company. When we first started doing it, the talent was me, John, and a couple people that we really wanted to start this together. And through time, it is earned with what we're doing, how we're doing it, that people are attracted to it, and they understand that they can be successful underneath it. So how do you find it? It's earned, it's networking, but also track record. It's a network plus track record effect that creates an earning dynamic that people can feel.
A network plus track record, right, that people can earn and feel. That's awesome, right? Because for me, whenever I try to scale a company, even my real estate portfolio, that was the critical element, right?
Yeah.
Even my head of maintenance, right? If he sucked, it cost me, you know how much in CapEx the next year because they sucked, right? So listen, It happens. We hired a head of maintenance, and then like after 3 months, I'm like, what's going on?
The same thing happens in venture capital land, right, Jerry? Is people go, well, I can't believe someone stroked a check for $200 million for this guy to go start an idea that everybody's had, and it's like, well, guess what? That person has a network and a track record where they know that he can put the team, the talent, the infrastructure together that they don't believe you can. It doesn't mean you can't.
Right.
They just don't believe it, right?
I get it.
Yet, right?
So there's a funny story, right? So a friend of mine was living in Venice Beach, right? And there was a guy jogging in the backyard, and he was having coffee at like 7 a.m., and the guy was leaning on his fence, right? And he's sweating, and he goes, hey, what are you doing? He goes, oh, I'm just taking a break. I'm jogging. He goes, I don't see you jog. He goes, I jog every morning, but why are you breaking? He goes, I had a great idea. He goes, what are you doing? What's your idea? He goes, I'm going to put rocket ships on the moon. I'm going to make electric cars. I'm going to put chips in people's brains that read everything and everybody. And my buddy's looking at him. He's like, this guy's nuts. He just left a loony bin, right? But who is that guy? It's Elon Musk. Right. So exactly what you just said. He's made it to the reputation. Right? Now,
if he has a new idea, they'll give him money. Like, that's it.
Exactly.
Like,
the guy says,
being investors, backers, etc.
Right.
And obviously he's talented, right?
Right. So it's what you said. It's the track record. And then I call it the 5 buckets of success. I think I stole it from somebody else, right? Knowledge leads to skills. Skills leads to network. Network leads to resources. That leads to reputation. And by the way, you can't skip them, right? You can't be... I think that guy's a lunatic. Yeah, sure, you're going to make monkeys do what with a computer chip, right? So you have to go through those steps. So it's interesting, right?
Yeah,
and I love entrepreneurship, right?
Yeah, that's cool. Yeah.
That's why I love it all. All right, so you want to tell us, this will be the last thing for the day, because don't forget, folks, this is a real estate profit boost, and the main reason is Jeff is here is for 1031 specialists, right? And he's basically scaled. I mean, think about the uniqueness of this, right? He's taking 1031s and scaling it. That's what he's done. He found a niche, he found an opportunity, he found an inefficiency, he made it more sophisticated, educates you better, right? And it's more affordable, right? And come on. That's entrepreneurship at its core. And this is a sophisticated gentleman. After interviewing him, we can tell. So I love the world of entrepreneurship. So when I first met you guys, I was like, holy shit, these are smart dudes.
Thank you.
Right? And that execute.
I appreciate all those kind words. That's very nice.
Right. So anything that you want to leave us with in closing that we could pick your brain for, that I probably won't even have a question for? Anything you want to throw out there? And I don't care if it's about spirituality, Bitcoin, real estate, or your family, right? Because everyone on this show is good people. Yeah.
Wow.
But everybody's
That's a big
Which
one.
is-
I would say, like, I don't know that I have something of personal note.
I could
other
phrase
than
it
to
in
say-
this question.
Yeah.
If you go back to, if you could tell your 18-year-old self something today,
Yeah.
right? Something like that, right? That, wow, if I knew this at 18 or before I went to school or
Yeah.
whatever it was, it would have changed my life. I'm looking for something like that.
Yeah, I in that framing it's something that I have always put myself what I felt to do, but I would say I would have told myself more directly is nothing, and it's really silly because it is an adage, and everybody says it, but nothing comes without hard work. There's no like freebies out there, and I've always been really dedicated and hardworking in all the roles I've had. I also would encourage people to always think, like, when you work for somebody, you're your own business. So always be thinking about, I would encourage myself, and this is also part just because I have friends who are in between things now. There's sort of weird pockets of different turnover, and certainly in the government sector, there's a lot going on there. I always try and think of myself like, how do you stay on offense with your own personal business, with just your own talent and what you do? And so it's, how do I keep expanding my network? Because you don't know when you're going to have it. And guess what? Like, the things, and this is what has been in my career, and I've always tried to stick with this, and I learned it along the way, is, I always hear people say, like, oh, you're so lucky that you're doing this or that, and not necessarily for me necessarily, but for others, right? And by being on offense, what happens is the opportunities, they happen, and they sort of bounce across, okay? And they can take a form of any type, right? Maybe it's a relationship you made. Maybe if you ask them, hey, would you be mind if I became a mentee inside your business? I'm really fascinated. I'd love to learn. Or it could be, an idea that came along and there really was a right way that you could go capitalize on it. But you've got to be in a spot where you have the financial means, the attitude, and the capability to grab it and not be afraid, because if you don't have those spots, then it becomes a thing where you don't. And then I think that is where I learned it a little bit in the middle of my career, trying to follow and be mindful of how people think about things and do things, and successful people. And that has been, while I'm still on my journey, folks that I have really felt did that was they put themselves in a position that when things came bouncing across their transom, they respected the fact that they saw it, acknowledged that it's there, and then tried to see if it was something that you can accomplish. But if you can't, you can't. But that's that.
Love it. No, I got it. It's like I'm going into the towel business, right? And
There you go. All right. I love
Right.
it.
Let's just say I'm in the towel business. No, because
Yeah.
you know what's so funny is I've heard something similar, and this gentleman used it as a metaphor. I'm going to go into the towel business. I'm going to manufacture towels, and one day I'm on an airplane, and there's no coincidence. I'm sitting next to the person who buys all the towels for Walmart. Right? And that's it. Because, first of all, you talk to the person, right? Because you actually asked, you put yourself out there. You created the opportunity. You decided you're going to sell towels. You created a factory. You did this. You did the hustle. You put yourself out there. You got a mentor. You did it, right?
Yeah.
So luck favors, I don't know what the old saying is, but the bottom line is, right. And we can
I think it's
even
like
ask
where
you-
preparation meets opportunity kind of thing, right? So it's
Correct.
It's
But the
flavor
key
of
secret
that.
sauce, you said it at the beginning, was the hustle, right? Because, my son can be prepared. He can go to college. I can teach him entrepreneurship. But guess what? If he's not aggressively seeking the opportunity, just like you said, it doesn't end up on your
And then in
plate.
the end, it's a bring it full circle. It's 95% of it's in the execution, anyways. So it's the execution as you work for somebody or you're on your own. So
Right.
Yeah.
I'll throw a crazy stat at you. So when I joined
Okay.
Entrepreneurs Organization 15 years ago, right,
Okay.
the threshold to get into EO and YPO back then was $1 million in gross revenue. And only 4% of the businesses in the United States had 1 million in gross revenue.
Wow.
4%. Right. So it just shows you what's out there. And if you look at the stats, now today to get into EO South Florida, entrepreneurs, it's $2.5 million, which only 1.4% of the businesses in the country do that kind of revenue. Now, I don't have the exact stats, but I've seen them before. Once you reach 10 million, you're in 0.5% of the
Wow.
businesses in the United States. And once you reach 100 million, guess what you are? You're in the Fortune 500.
But
So-
isn't it interesting that 70%
Yeah.
of our GDP comes from small business? So it just shows how much is very
Right.
small, right?
Right.
And yeah, so
And
it's,
that's the
interesting.
lifestyle. That's when we refer back to, like when you hear them on the politics, right? Main Street versus Wall Street, right?
Right.
So, but just, I mean, the people that are on this podcast, you're already in the top 1%. You don't even realize it, right? And your mindset has gotten you there where, yeah, I'm looking out the window of my office building here that, and I see, Jimmy John's subs. They do $600,000 a year. They net 15%. That's your average business in this thing. So I like that you brought that up. But listen, you heard it here first on Real Estate Profit Boost, right? Those are the key secrets and the little nuances that make the difference in execution and opportunity and luck. And the whole thing for me is I love to create a community that shares values. Right? We share values. We help each other. That's my main concern is, can I help Jeff? Can I help 1031specialist.com, blow it up? Because number one, I know the founders and I know how they execute and I know their value systems and their motivations, right? I'm a faith-based guy and I believe in the law of the universe. And so I know these guys do too. And what I'm trying to tell you is, number one, if you should share this show with other people, right? Because the comments that you put below on YouTube or wherever you're seeing this, you may see something that we don't. So put your takeaway in those comments and things, and you start to create a community that engages leading real estate investors to learn and grow from each other that that share the same values. And that's really my goal, and to bring on rock star guys like this so I can learn from. So one more time, Jeff, where can we find you? How do we work with you? Obviously, there's going to be links down below to him, to 1031 Specialists with an S.com, and anything else. How do we find you?
I
buddy?
mean, I think the easiest way to find us is go to www.1031specialists, plural, so with an S.com. All the ways to get a hold of us are there, and it's certainly the easiest. And, you can search me or anyone else on our team there. And guess what? When you call, there's a good chance it's going to be me who picks up the phone, right? Because we are in the trenches with you. I deal with clients directly.
That's big.
And so this is this is what we're doing. And
right.
We look forward to meeting anybody. And I'm big into meeting new people and trying to expand the folks that I can know and learn from and hopefully help out just like you are. I love your attitude and the tone of what you're trying to do, and it's really awesome. And I aspire to try and do that as well. So
awesome.
Thank you very much for that.
By the way, little secret. Guess what, guys? You got a guy in the top 1% of real estate investments. You heard the knowledge. If you reach out, it could be him picking up the phone because they use technology to scale the company, and there's only 2 or 3 of them. So guess what? You can pick his brain. That's big. Not everybody knows that, right? You don't know who's in the room. Now you do.
Now you do.
That's it. All right. Jeff, you're a rock star. Really appreciate your time. Thanks for coming on here. You guys are awesome. We're going to be talking about this for years to come. It's scaling out and growing and big and so on. Thanks again, everybody. Tag, do all the fun stuff on YouTube, spread the word, all that good stuff. Jeff, it's been a real pleasure. We're out. And I always say peace, love, everybody. Have a great
Pleasure's been all
one.
mine.
Thanks, Jeff. You want higher profits without higher risk. The blueprint's right here. Hit subscribe and watch Real Estate Profit Boost.